was another good week for mortgage rates. So mortgage rates have continued to improve. We've had a slow, gradual improvement, which is the kind of improvement you like to see. The fast improvement, the quick improvement, the big moves in a single day. They're not often sustained, but right now we see mortgage rates gradually coming down. We're at some of the best levels we've been in a couple months. So that's good news for mortgage rates. I'm going to bring on Barry Habib from MBS Highway. He's talking about, some of the crisis in the banking with Deutsche Bank today. And I'm going to let Barry get into this going on. So I'm going to bring on Barry right now.
Better pricing today. They're kind of gaining in a grudgingly fashion, but the 10-year Treasury is really where a lot of the flight to safety has been going. And we've been seeing more of a disconnect. But the 10-year Treasury right around 330 right now. If you compare it to last summer, not so great. Last summer, in case you don't recall, we saw the 10-year Treasury much lower than present levels. And then we have today, about 330 kind of looks good because it wasn't that long ago. We were, 430 back about 5 or 6 months ago. So a nice improvement. I expect mortgage-backed securities, once the dust settles a little bit and we see where they go, to start to show some signs of improvement, especially when we see inflation come down. And it will, because a lot of the problems in the banking sector are going to lead to less lending. Now, the Fed will tell us that, hey, everything's okay. Janet Yellen will get up there, nothing to see here. So if everything is so great and everything is so sound, why has the Fed's balance sheet risen by $400 billion? And it all comes from borrowing from banks. So let me just try to explain, while borrowing from the banks is not something that they really want to do, but it seems like they are almost desperate to do. You see, borrowing from the Fed is like going to the lender of last resort. Let's explain. The Fed is going to charge you to borrow from them. Now, what the Fed allowed you to do with this new facility that they put up is they said, okay, you've got these assets that are going to be held to maturity on the long term, but they're underwater. If you got $100 billion in long dated maturities like mortgage bonds, and because you bought them at a 2% coupon, and now the coupon's 5.5, you've got to have a discount on that if you want to bring it to market value. So normally you would have to take that haircut, and maybe it's worth somewhere in the neighborhood of, instead of 100 billion, 75 billion. Well, the Fed says, we're going to do you a favor. We'll let you borrow considering the value is at face value at 100 billion. That's a nice thing. And that's one of the reasons why they're able to really help here. But you still got to pay us. Fed's got to get paid, right? And they're right now, the rate that they're charging on this facility is 4.375. It's going to fluctuate a little bit, but right around there. Now, at 4.375, it doesn't seem like it's a lot, but it is a lot when you're talking about all this money. Now, the assets you're pledging against it, you still get a rate of return. But remember, that rate of return is only at 2%. So why would anybody do this? Why would a bank do it unless you're desperate for the money? That would be like you or I going to our bank and taking out a home equity line of credit at, let's say, 5%, and then putting in a bank account that gains 2%. Why would we do it? Nobody would do it. Why are these banks doing it? It's because they desperately need it. So when they say, oh, the banking system is so great, nothing to see here, don't believe it, folks. We're seeing more and more of this because the Fed comes in, or central banks come in, or governments come in like a bull in a china shop. They can't see 2 steps down the chessboard, and they do this. They don't understand this is a Rubik's Cube. They look for simple solutions, simple answers, but they don't know what intended consequences means. We've seen it over and over. And Dan, today you've done such good work on breaking down what is going on right now with the big headline today, and that's Deutsche Bank.
Yeah, this is really them coming under pressure because of a precedent that was set between Credit Suisse and UBS with that takeover. And let's first talk about how the hierarchy normally works in the case of a liquidation or a bankruptcy. Typically, your bondholders would get paid first. They have preference, and then the equity holders come after that. But in this Credit Suisse and UBS deal, the equity holders actually got 20 cents on the dollar for their shares, but the convertible bondholders, they got nothing. And the problem with this is that while this may have helped that specific scenario, it's like a Rubik's Cube, and it has unintended consequences because now when you look at Deutsche Bank, the bondholders there are not feeling so confident. The precedence was set that the equity holders actually got preference over the bondholders. They broke the system here. So this is causing all kinds of pressure. Who wants to hold these bonds? It's costing much more to insure them. It's weighing on the stock price. And at a time when these banks are having liquidity issues, this is certainly not going to help their capitalization. It's not going to help for them to have investment there. So another problem here that's arising, an unintended consequence.
So Dan, let's talk about these bonds. These are COCO bonds, right? Want to break that down for us on the COCOs?
Yes. So these are contingent convertible bonds, which means that they are a debt holder of the bank. And then they have the ability to take that debt, and at a certain strike price, they're able to convert that into equity shares. And as previously mentioned, these debt holders are supposed to have preference over the equity holders. But in this specific scenario, the equity holders got paid something, and those convertible contingent bond holders got nothing.
They got wiped out. And that really, if you think about it now, if I'm an equity holder, I know what my risks are. Okay. So I know that if we go under, I can lose everything. But if I'm a creditor, I'm supposed to have first dibs. Now, these COCO bonds, they were on the lower rung of creditors, but ahead, as you say, of equity. And when you flip flop and you say, okay, you're next in line, but you're going to get skipped and pushed to the side, and we're going to pay the equity, that creates desperation and fear amongst other bondholders that says, holy cow, can I get pushed aside too? As you said, Dan, they're breaking the system. How these governments, how these central banks don't understand that by doing something like they do it out of desperation, say, okay, we got a fire here, let's put out the fire, but they don't understand the unintended consequences. Now, I'm not saying good, bad, indifferent, whatever, but they don't seem to be thinking these things through. The market's thinking it through, and Deutsche Bank's paying a heavy price. Because Dan, now what happened if you want to raise capital? These things are used to shore up their balance sheet, aren't they?
They are. They were created in 2007 and 2008 during the financial crisis, as you said, to shore up the balance sheet. So, again, in situations where liquidity is an issue out there and there's pressure on these banks, this is not going to help.
No, because now you got to raise it. So what will they probably do? Hey, we'll make this more appealing for you and tastier for you by insuring them. Okay. But insurance isn't free. Insurance isn't cheap. And that cuts into margins, which cuts into lending, which means less money out there, which means probably less inflation, which means we're headed for recession, lower rates, maybe across the globe.
Well, thank you, Barry. So Barry's predicting rates coming down and potentially recession around the globe. So that's the update for this week. Listen, all this news is good for mortgage rates. And if you want to schedule your one-on-one appointment with me, Jerry DeMeo, please go to www.mortgage-zoom.com. The appointment's going to look a lot like this. And I'll see everybody next week. Thank you for all your support.